Hey everyone, welcome back to Dividend Stockpile, where we talk about all things dividend income investing related. Today, I'm sharing 3 new stock buys I recently made from my Quality Dividend Portfolio. These are companies with strong fundamentals, consistent dividend growth, and sustainable business models for the long haul. These 3 stocks are all lesser known dividend gems that I believe deserve more attention. So let's dive into the breakdown of each business, go over the quality and dividend metrics, and I'll share exactly why I bought them now. So let's jump in. Before I share the exact purchases, I wanted to give a little context to the strategy I'm pursuing. If you watch any of my How to Build a Dividend Growth Portfolio from Scratch series, you know that I'm building up a long-term, buy and hold portfolio of only the top quality dividend stocks. It has been my goal and focus for 2025 to find the best dividend growth stocks. With all the turmoil that I was expecting, and to be honest, we've already seen this year, I knew that quality had to be a priority. So, with that, I have embarked on identifying the most important criteria and metrics for quality dividend growth stocks. And I've been tracking them on my custom spreadsheet. Right now, I'm tracking over 700 dividend stocks. And believe me, not all of them are great. There are actually only a few that have the features to be considered for my quality dividend portfolio. So my goal for this portfolio is to dollar cost average into 25 to 30 stocks over time that meet most, if not all, my metrics. I am currently buying around $600 every 2 weeks when I get paid. So with that background in mind, here are the 3 stocks I added to the portfolio this past week. First is FactSet. FactSet is a leading financial data and analytics provider offering tools, feeds, and solutions used by the investment professionals. Think of them as like a mini Bloomberg with a niche focus on high-quality, customizable data sets. Their clients include asset managers, hedge funds, and investment banks. They really do cover the full length of a end-to-end portfolio lifecycle, starting from the front office and the middle office of investment firms to do all their different research and analyzing stocks and other funds. According to the company, they're expecting their EPS growth to be about 12%, and revenue growth of 5.6%, and ASV retention, which is their subscription value, is about 95%, and they're planning on that to grow about 4.8% a year. They've been in business for 46 years, and they have 44 consecutive years of revenue growth and 28 years of adjusted earnings growth. And they've been increasing their dividends every year for 25 years. They have about 37 offices with 8,000 clients, and global users is about 216,000. So they're expecting their subscription values to grow throughout the world, with EMEA accounting for about a 3% increase, Asia Pacific at 7%, and the Americas at 4%, so for a total of 4.1% growth. And they recently established their fiscal outlook for 2025, and as you can see, all the metrics seem to be very stable and consistent, and it's a growing company overall. So let's dig into those metrics. As I mentioned before, I keep a spreadsheet of all the quality metrics I look for, and FactSet meets all but one quality metrics that I track, which I'll list off in the columns on the right. So first off, return of equity, they're at 27.64%. Return on invested capital is only 15.32%, and that's the one area that they're slacking on. EPS growth next year is 18%, and the next 3 years of EPS growth is about 19.87% forecast. Gross margins for the last year is 54%, and the average for the last 5 years is 52.94%. Free cash flow margin over the last 12 months is 25%, and their average over the last 5 years is 28%. CapEx to revenue for the last 12 months is 4.39, and a 5-year average of 3.73%. Revenue growth over the last 12 months is 5.64, and their average for the last 5 years is 9.04. The earnings grew 15% last year, and they had a historical 5-year average of about 9%. Their debt is very low at 0.81, and their net debt to EBITDA is 1.55. Let's move over to some dividend metrics. Their current yield as of the time of recording was 0.99%, and their 5-year average yield was only 0.84%. The dividend coverage ratio shows how much the company can cover their dividend from free cash flow. It's about 3.34 times, and their 5-year dividend growth rate is a solid 8.59%. The free cash flow yield is higher than the dividend yield. It's 3.5 compared to the 0.99, which means their free cash flow is growing faster than their dividend. And as I said before, they have 25 years of consecutive dividend growth. When it comes to valuations, there's a couple ways to look at it, but the current PE is about 30.32, with historical being about 35.71. So based on that, it's a little under their historical average when it comes to PE. And using the forward estimates, 1-year PE is only 23, and the 3-year is 21.53. As I mentioned before, the dividend is 0.99 with an average of 0.84 over the last 5 years. So based on the dividend, it looks like it's undervalued at this time. And lastly, we're going to talk about total metrics. So the 1-year total return is 5.08%, which is not too bad, but the 5-year average is 7.92. So when you combine the total return that they've been receiving over the last 5 years, plus the dividend growth that they are seeing, plus the future growth that is expected, this is a good, solid, stable company. And in fact, I consider it to be a compounding machine with a sticky subscription model and high operating leverage. And yes, the yield is low, but the dividend growth is consistent, and the free cash flow easily supports it. This is a long-term compounder with pricing power and a moat in the financial data space. All right, so next up we are looking at ResMed. So ResMed is probably not someone you've heard about, but what they do is they are a global leader in sleep apnea treatment and respiratory care solutions. And they also have a digital health platform that connects millions of users. Their CPAP machines, masks, and cloud-connected software serve a growing market with an aging population, increasing sleep disorder diagnosis. The company was started in 1989 and operates over 140 countries. So according to the company, here are some things that make it a good investment. Their gross margins continue to improve. Their cash flow is high and growing. Their balance sheet is very stable. They have a net cash position of $260 million. And they're adjusting their supply chain to focus increasingly on U.S. manufacturing, which is going to be a key part of this administration going forward. Current leadership has managed through the global financial crisis and COVID, and their markets are large and growing, and their total addressable market, they say, is about 2.3 billion people. So as a high-level overview, what do? They focus on sleep health, breathing health, and care in the home. So they're not only looking at hospitals and nursing homes, they offer their clients in-home care. All right, some statistics that the company provided. They have 32 million people on one of their AirView, which is their computer-based digital platforms. They have 29 million cloud-connected devices worldwide, and they show that they have about 4 million diagnostic tests processed in their cloud network. All right, looking at their revenue by business, they have 3 main categories. The first one is devices at 52% of their revenue. Mask and other is 35%, and OOH RCS is 13%. Now, OOH means out-of-hospital care. So this is your nursing homes and your at-home services. And they have a global footprint. 58% is from the U.S., Canada, and Latin America. 29% is Europe, Asia, and other. And 13% is their out-of-hospital care. All right, as I mentioned before, they have a solid balance sheet with operating cash flow increasing, capital expenditures decreasing, and free cash flow continuing to rise over time. So let's look at the quality metrics that I review. And to be honest, ResMed is the best of the 3. They've beat all my metrics. So return on equity at 25%, return on invested capital at 20.14%, EPS growth for the next year and the next 3 years is 11.51% and 10.58%. Gross margin for the last 12 months is 58%, and over the last 5 years, it's averaged almost 57%. Free cash flow margin is 31%, and for 5 years, it's about 18%. CapEx to revenue is very low at 1.76 this year, and an average of 3.44% over the last 5 years. Revenue growth over the last 12 months is 10.95, and their average for the last 5 years is 12.49. And their EPS growth for the last year and the last 5 years is 13.4 and 23.9% respectively. They have very little debt. Their debt to equity is only 0.15, and their net debt to EBITDA is actually negative. Some dividend metrics. Again, the yield is 0.85, and their average 5-year yield is 0.82, so they're a little bit undervalued there. Payout ratio is a very low 23%, and their dividend coverage ratio is 3.27 times. Their 5-year dividend growth is a little on the low side, but it's very consistent at 5.4%, and their free cash flow yield is higher than their dividend yield, again, meaning their free cash flow is growing faster than their dividend, and they have about 12 years of dividend growth. So moving on to valuation, the current PE is 28.3 with a historical 44, so it looks pretty undervalued that way. Looking at forward forecasts, the 1-year PE is almost 24, and the 3 year is a little over 21. Dividend is 0.85 with an average yield of 0.82. Total return, they're doing very well this year with a 18.78% over the last 1 year, and their 5-year average is 8.67%. So why did I buy this one? Well, it hit all the metrics I look for, and it gives me exposure to the healthcare sector, and they have a very high technology base. Their connected ecosystems add long-term stickiness and recurring revenue, and while the dividend yield is modest, The growth runway is huge, and the balance sheet is very clean. RMD is a future-proof company riding demographic trends. And last up, I bought Watts Water Technology, ticker WTS. Again, you probably haven't heard of this one, but they're a global provider of plumbing, heating, and water quality solutions. Their products include valves, regulators, backflow preventers, and smart monitoring systems, all critical infrastructure for clean water delivery and safety, especially in commercial industrial settings. So some basic information about Watts Water. They operate throughout the world, with Americas being 74%, Europe being 20%, and Asia Pacific being 6%. And their end markets are split between new construction and repair and replace. And they offer it to non-residential as well as residential clients. One of the things I really liked about this particular company is their commitment to water conservancy. So what they're mostly focused on is the water conservation and energy efficiency, which leads into my desire to find an ESG-friendly water company. One of their ESG strategies is to reduce the carbonation of their processes. They're looking to make sure that their suppliers are adhering to ESG principles. And they're looking for a sustainability integrated at every level of their operations. So looking at the quality metrics, this one is a little bit lower than the other two. They met all but two of my metrics. Return on equity is only 17%, and the return of invested capital is 14.41. So it's a little bit lower than my goal, but all the other metrics look great. And if you look at the long term, the return on invested capital is actually well over 20%. So the EPS growth for next year and the next 3 years is 10.67 and 9.91. So they're looking really good for their future growth. And their margins are solid at 47.65% for the last 12 months and 44.66% over the last 5 years. Free cash flow margin is at 15% last year and averages almost 12% over the last 5. CapEx to revenue is extremely low at 1.55 for the last 12 months and 1.76 for the last average of the last 5 years. Revenue growth over the last year was 9.53%, and for the last 5 years, it's averaged 7.40. EPS growth is 10.7 last year, and over 20% over the last 5 years. Debt to equity is very small at 0.11. Dividend metrics. So the current dividend yield is 0.75%, and their average 5-year yield is 0.71. Their payout ratio is extremely low at 19.75%, and they have plenty of cash flow to cover the dividend at 4.8 times. Their 5-year dividend growth is very strong at 12.68%, and again, their free cash flow yield is much higher than their dividend yield, showing that they have ample cash to pay their dividend. And they've been growing that dividend for about 12 years now. Total return, this is where the company really shines. The last year, the total returns is 30.55%, and on average for the last 5 years is 25% a year. Can't get much better than that with a boring water company. So why did I buy it? So I've been looking to get into the water supply space for quite a while, and this is a high-quality industrial play with exposure to critical infrastructure trends like water conservation, urbanization, and building efficiency. It's a quiet compounder, and no one really talks about it, but it has a rock-solid balance sheet, great margins, and plenty of dividend growth room ahead. So there you have it. FactSet, ResMed, and Watts Water, 3 high-quality dividend growers that I've recently added to my portfolio. Each of them has strong fundamentals, excellent dividend safety, and a lots of room to grow over time. So let me know in the comments, have you looked into any of these stocks before? And are you buying anything else before this month ends? And if you got value out of this video, make sure you hit the like button, subscribe to Dividend Stockpile, and tap the bell so you never miss another episode. Until next time, keep stockpiling those dividends.